You're listening to the Jewish Entrepreneur Podcast with Debbie Sasson, episode number 175. Welcome to the Jewish Entrepreneur Podcast. I'm your host, Debbie Sasson. I went from being a financial advisor, author, and chronic under-earner to building my business to six figures as a financial planner and money mindset coach, and then onto multiple six figures as a full-time money and business coach. I help entrepreneurs create money-making businesses and build wealth using sales and money mindset strategies and in alignment with authentic Jewish values. Now, let's dive in to today's show. Hello, my friends, and welcome back to the podcast. I am really enjoying being back with you for season 3 of the podcast. This week, I have a special episode for you because a couple of weeks ago, I did a webinar specifically on personal investing for entrepreneurs. I did it with my friend Kim Gilroy. She is a business coach, a 10X coach with Grant Cardone. We had an amazing discussion with all the people. There were about 90, 100 people registered for the webinar, and they really came with excellent questions. So I wanted to give you a peek into that webinar. Now, it was with a slideshow presentation, all the things, bells, whistles, etc. I will leave a link in the show notes so that if you wanted to, you could go and watch the full presentation. But I really wanted to share the 6 big barriers that people have to getting started investing, including they don't know the financial language, the jargon, whatever it is, that's a big barrier. And I do want you to believe that if you have come this far, that you can figure out how to turn on your electric device to listen to this podcast, then you are an intelligent person and you can figure out investing. It really is not rocket science. And then we talked about other specific points like fluctuating income, which is an issue for entrepreneurs, or it could be that you don't know when you should start investing. And what about loans? What about an emergency fund for your family? And we went into all of those details, including the mindset around money is a man's world. So I encourage you to jump into this episode. And then if you want more, hit the link in the show notes, go watch the full episode. And of course, you can go onto Amazon and get my book all about investing, The 1K Investor, Simple Smart Steps to Start Investing with $1,000 or less. I will leave the link to my book in the show notes as well, because really I think of investing as set it and forget it. You put your money and you can even set it up on autopay. $100 a month goes into your investing account, and you're going to wake up one day, one fine day in retirement, and you will have grown for yourself a beautiful nest egg. So without further ado, here is the webinar. So let's just talk about investing because people mix up saving and investing. So this is a little bit of a geeky term, but it's important that I got a little geeky here. So investing is the committing of resources to an endeavor or thing with an expectation of a positive return. I know that sounds a little geeky, right? Committing of resources. You commit money to an endeavor or a thing. So you could commit it to your business. You can commit it to stocks. You can commit it to real estate. You can commit it to cryptocurrency, right? You're going to take money and you're going to put it in something, and you're going to expect that after a period of time, it's going to give you money babies. You're going to have a positive return on those resources, on that money that you put away for the future. Okay, so here it is in words. You commit money to financial assets. Again, that could be real estate, that could be stocks, could be bonds, it could be crypto, it could be diamonds, gold, right? Right. There's also, all the commodities you talk about, oil, wheat, but there's an asset, right? And you expect that your money is going to grow over time. There is an element of risk, right? Because we don't know what's going to happen in the future. Do I know if the price of gold is going to double? Do I know if it's going to drop? We've just had a huge, like over the last 6 months or so, the price of gold has gone really, really high. Crypto, if you followed it for like the last, 5, 10 years, I don't follow crypto, but it's been all over the place. It's been high, it's been low, it's been high, right? But we don't know. And what's risky about it is really the volatility, the fluctuation in the price of this financial asset during short periods of time. And if it is a solid financial asset, like a property, like stocks, and we can talk about why stocks are really not risky if you have a 10 to 20-year time horizon, like they're really, really not. Over long periods of time, the US stock market, we have over 100 years of data, has grown on average 10 to 11% per year. But that again is on average. You can have a year when it's up 20%. You can have a year when it's down 20%. You can have a year when it's up 40%. So in short periods of time, there can be huge fluctuations, but over long periods of time, the risk really, really does. I don't want to say go to zero because it's not zero, but over time, the risk gets less and less. So investing is going to be long term. If you know that you need money in a year from now or 2 years from now, like we get the idea that if I invest in a property, it would be really hard to get it out. Or I might, buy a house and I would have to sell it and I might sell it at a loss or I won't find a buyer. I'll have to really, really drop the price. Like that makes sense to us. But in terms of, the wanting to have a long-term horizon with stocks, because again, prices could go down, markets go up and markets go down. So you really have to go into investing with a different mindset from savings. Savings is where you keep your money when you want it safe. You know your kids are going to go to college next year and you need to put money into their college fund. You have money in savings. If they're 4 years old, then you can put it into an investment account like a 529 or something like that where you're investing for the future. If you have children that are getting close to marriageable age, right? Like you don't want to have money that is going to be fluctuating when you want to be making a wedding. So you have to understand what your needs are, what you want to do with the money, and does it make sense for your money to be invested or does it make sense for your money to be in savings? But people tend to like mix up those terminologies when they're having regular conversations. I'm saving for the future. Well, if your future is in 15 years from now, you should be investing for the future, not saving for the future. Because if you keep your money in safe savings in the bank account, you're just going to earn like, I don't know, maybe you get 2, 3, maybe 4%, but you could be getting 10%, 11% on average, for example, in the stock market. So that's what investing is. So you could just tell me in the chat box who already has some investments, who already understands a little bit about investing, right? Just let me know. And if you don't have social media, I understand. I apologize. That's just, we share something.
So I think what you just said is really important. And do you have a specific school of thought? So, there's different people, different investors, different money guys or gurus all have, their own 4 steps or 3 steps. I'd like to hear yours. And so I'm curious for those who are listening on the process of investing, like when to invest in yourself, when to invest in your business. When do you know it's time to start investing versus savings? Do you have a school of thought just from your own life specifically that you'd like to share? Guys, do you want to hear that? Was that something that would interest you? I get that question a lot from clients. It's like not knowing when because they're investing in themselves and they're trying to start a business and they're like, I need to do Facebook. When do I invest in me? Yeah, they're saying yes. So
Yeah. So okay. So that's a really, really good question. So let me just right now, let me stop sharing the screen because just makes sense for me to look at everybody rather than, seeing my cute little picture. So listen, guys, we have to be realistic. Life happens. Right? There are always going to be unexpected things. The most, like my dad calls them oopsies. Like oopsies are going to happen. Life happens. All of a sudden, your car is going to have a flat tire. Your kid is going to need like dental treatment. Your computer is going to fritz out on you. You need to have money in what you call a rainy day fund, an emergency fund, something like that. If you are an entrepreneur, because our income fluctuates, right? So the common wisdom is to have 12 months, like a full year, right, of how much you need to take care of your family in like a rainy day fund for things that are unexpected. Okay. Now, like that's a lot of money. Like if your family needs $50,000 for the year or $100,000 for the year to have that much money parked in an emergency fund, like that's a lot of money. And I think it might be a little bit too conservative. I would be happy with half of that, but really at the very, very minimum, put $2,000 to $5,000 away in an emergency fund for those emergencies that you don't know what they are or when they are going to happen, but you just know that like the plumbing is going to like go on your house and you need to pay the plumber before the insurance company pays you back. So that's one kind of savings fund. Now, there's another kind of savings fund for the things that you know are going to happen in the next year or two. Like, you know you're going to be taking a summer vacation. If you know you're going to send your kids to summer camp, if you know that in, January, like my husband and I know that our house insurance, our home insurance for all of the contents, we pay it every year in February, February, March, April, May. We do a 4-month payment plan every single year. Like that money, that's coming up. You should be having that money saved. So, for example, if you had, let's make it easy. If your home insurance was $1,200 a year, you should be budgeting $100 every single month into an account for fluctuating expenses, like they don't, or irregular expenses. They're not happening all the time, but you know full well that they're going to happen. We also know that, like, God willing, you're gonna get to, like, 80, right? Like, that's the average life expectancy even more, and as medical technology, improves more and more, you might expect to get to 85, you might expect to get to 90, so you should really start investing as soon as possible. But that's why I wrote my book, The 1K Investor, because you can start with $100 a month, and really over the long term, you can build a $500,000 in investments just by $100 a month. But people wait. They're like, no, but I need to do this first. I need to do this first. And before you know it, you're 55 years old and you don't have money in investments. So just like that you might be paying your home insurance or you might be paying your car insurance or something like that, like, there's like I don't know, 80-90% chance you're going to get to 80. Right? So, like, don't sweep it under the rug. If you haven't started yet, like, start now. Like, it's gonna happen. And then you have to look at your income and you have to look at your expenses. And I think that one of the biggest problems that entrepreneurs have is that they're not separating between their business and their personal expenses. So there's one big melting pot for all of their income. And so the money comes in. I was working with a client about like 6 months ago, and the money was coming into the business and they were swiping the credit card to pay for therapy, to pay for this, that, like, there, it was such a stew of everything, like, all mushed together. But you need to have a Chinese wall between your business and your personal life. You need to know how much it costs to run your personal life, because your business needs you to keep reinvesting in your business. Your business is going to need you not just to get a Zoom account, not just to pay for a Canva account, but to invest in other assets for your business, especially if you're a product business. And this is where business owners who have product-based businesses are different. And I think they're a little bit more, like, financially savvy than service-based business owners. A product-based business owner knows that they need inventory, right? They need to have, like, goods, and they need to have, like, especially if you're a brick and mortar, you have a shop, you need to rent the space, renovate the space, turn on the water, the electricity, stack the shelves. You need to invest in your business before you've sold one item. Service-based business owners like, no, I have a Zoom account. I'm good. I don't need to invest in my business, and they really shoot themselves in the foot and they, like, slow down their growth. But your business needs to have its own business account. You could, just like a product-based business owner can take a business loan to get going. If you got a service-based business, rather than taking all the money and, like, bringing it over to your personal life, I've recommended this to clients. Take a loan, put, let's say, $50,000 in your business bank account. Pay yourself a salary from that money every single month so that you can, like, breathe, and your family's getting taken care of while you're building a business. And the other thing is that, when it come in a second, but, like, we want to have it all in our personal life straight away. And I don't know if it was Suze Orman or if it was Dave Ramsey or just whatever, but a lot of people have said in the financial world, like, you want to live like nobody else so that you can live like nobody else. Like, keep your personal expenses down, 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 down. Now, and I get, as a mom of 8, it is really hard. 8 kids, 8 pair of shoes. Like, no kid has only 1 pair of shoes, like, maybe your 1-year-old. But, like, they want shoes, they want clothes, they want extracurricular activities, they want, but you've gotta, like, squeeze your personal, like I told you, I went to clean houses because my dad was let go of his job and he was starting to build his business. He's like, "Sorry, kids." I remember the Hanukkah when he told us that, I got a turtleneck sweater. That was the only present that I got that year. Like, my parents modeled such sensible financial habits. They didn't say, okay, we'll figure it out. We're going to buy you guys the moon. And we were 5 kids. Right. So I'm not talking about, someone who has like one child. I'm talking about, a pretty large family. And it was like family holdback. And I know it's hard. I know we live in the age of abundance, and I don't want to be dismissive of anybody's anything, but if you can live like nobody else for the first 3 to 5 years of your business will produce income like you're doing well, and then you're going to have so much more for the future. All right, Kim, what do you want to say?
Thank you. I was going, so I'm liking to take notes and then kind of break some of it down because you talk this is your world, right? But I notice for some people when we say things, wait, but they're not there yet. So my question was, and someone actually followed up with it in the chat. Could you break that down in a formula? So, and I'm not sure, if these are new business owners or if they've been business owners for a while, but I'm going to assume that since this is for beginning investor entrepreneurs, we're just going to assume just for you to give foundation. And then if they're more long term or what's the word I'm trying to say?
More experience.
Sure. Yeah, exactly.
Yeah.
Then we can address that. But let's just for the sake of getting this down and recorded, and if anyone's finding it, it can help anyone. Is how would you break down that formula to start? Like how to get their first $1,000, to get that first 50,000, you know what I'm saying, or that first 20,000. Something simple that I'm sure you are doing naturally, but someone hasn't thought to do it because they're used to being an employee. They're used to getting a check in a different way. Because I see this with a lot of new coaches and service-based entrepreneurs, massage therapists. They literally take the amount of clients that they need to pay their core note. That's all they know. And I respect that because I remember coming from that. So I'm curious, what would be your formula that you would, for the person who's never put anything aside, not really thought about it, they're now like, okay, I'm taking this serious. What's a simple formula they could start with? How much? Or is it a percentage? Or um, like, what's your school of thought?
So the first thing is to know your numbers. How much does your family need?
Okay.
Okay, that would be number one. And then try to reduce it by 10%. And that might sound like a big number, but if you go through all the little expenses, right? If you go through a little at a time, right, and you take a little bit off of here and a little bit out, like you reduce your clothing expenditures, you reduce maybe your car expenditures, you reduce your vacation, you reduce your food expenses, right? Like try and like trim everything down, right? And then you have money coming in. And again, you take that money, start by putting aside $100 a month into an emergency account, and remember, you're gonna have these fluctuating, expenses. You've gotta know what those are because the money that's coming in needs to cover those. So you've gotta take the money coming in and you have to allocate some of it to the future. Like give your $100 to put in your investing, $100 to put into your emergency account, and then take money and put it into the unexpected or irregular expenses, those ones that you know are gonna happen. They're just like 6 months out. Because if you don't, then what happens is you go into a frenzy when all of a sudden you're like, "Oh my gosh, right? I have to like pay for my car insurance and like where's the money?" It's like, but you knew that was coming.
I remember this. I would put the money aside. They used to do a Christmas club back in the day when I had little kids. And so I would go to the bank and you would put $20 a week. You would just give them $20 and they would basically hold the money for you until birth. So then you had the however much to go and do your shopping. And that made sense. But here's what you just said is what I would do. Then something came due that I wasn't planning for, and I would take it from that investment account.
Yes.
So
Yeah, or it's a savings account, not an investment account.
that's what I wanted you to break down because someone's saying, let's say I have 1,000 to start investing. Let's get to the point to where they actually have the 1,000. So you're saying if they put 100 a month, they're going to have 1,200 by the end of the year, and then they put another 100 a month. So one's a savings, one's a investing. Now they have 2,400. So the 1,200 for emergency or whatever stays, but now they have 1,200. Where should they put that first 1,200?
Okay, so this is that I break down in my book, and it's different depending on where you are in the world. I love stocks. Let me just give you a little bit of background around stocks, especially for those of us who are business owners. People freak out a little bit about stocks. I told you that over the long term, right, stocks are pretty safe. I don't want to say, they are volatile in the short term, but what is a stock? A stock is an ownership interest in a company. So if I own stock in Coca-Cola, I own part of Coca-Cola. That means, right, if I own stock in Apple, I am a partial owner of Apple. If I own stock in Amazon, I'm a partial owner of Amazon. I own stock in Citibank, I'm a partial owner. Over long periods of time, like the economy grows and the value of the stock increases, these companies become more valuable. That's us as entrepreneurs. The idea is that over time, your company grows, your income grows, and your company is more valuable. Your profit margins increase. So that's why, like, if you invest money in stocks and you don't even have to wait for the $1,200 if you have an investment account in the United States. Okay. So what I prefer is there are funds. A fund is like you can either have a mutual fund or an exchange traded fund. A fund is basically a collection. You can go to the like Whole Foods and you can either buy your lettuce and your cucumbers and your tomatoes and your mushrooms and your peppers separately. Or you can go and buy one of those little containers that has everything already in it. Your salad is already prepared for you. So a fund is like your salad, your investment portfolio already prepared for you. My personal love is the total US stock market, right? And I have an account at Fidelity, and you can invest in iShares. It's a company. Now we're going to get really into the weeds of invest. I don't really want to go here right now. Again, if you go out and you share this and we'll talk about it, we can go much deeper. But like I own, just by owning one share or like 100 shares of the total US stock market, I basically own little bits of like thousands of companies in the United States. I don't have to think. I don't have to think, oh, is IBM or Apple going to do better this year? Should I be investing in tech? Should I be investing in biotech? Should I be investing in real estate? Should I be investing in consumer goods? Right? Like, I don't have to think about it. I don't have to spend any time. There is a computer algorithm that's running in the background that's all the time monitoring the markets and making sure that my little salad that's already pre-prepared pretty much mirrors what is happening in the total US stock market. So I can leave all of my worries or stock picking aside and I can take my energy, focus it on my family, focus it on my business, and making sure that I'm relaxing and not getting stressed out.
I like where this is and what Debbie's offering is we're gonna have her contact information, and she's offering to go down in that a little bit deeper for those who wanna do a Q&A, but for today, we're gonna do an overview, because
Yep.
the first thing is you gotta get the money. You gotta put the money somewheres because it
You gotta do the money and you gotta get the terminology because even this, like, if we just stopped right now, like, people would be like, "Okay, Debbie, you just gave me a lot of jargon. I need to go home and digest that already," because we've talked about stocks, we've talked about emergency funds, we've talked about, like, irregular expenses and total US stock markets and ETFs, and you're like, "Oh my gosh," like, my head is already like
which is
So
great because you know there are a lot of options.
Mhm.
That's good. And we also know that we wanna choose something that's more low risk, but everything has a risk, like it or not, even though we say 0 and near 0, so we can cover those. So, I'm curious about coming back. So, we know that that's gonna be an option, we can go deeper, we're gonna do a Q&A after this. Let's get back to the show with the part of so now that they are starting to put money aside, and some of these might already have money to go, they need
Yeah,
to book a call with you and then they can get some guidance or a conversation with you. But we're going to assume
yeah,
that they want more money put aside. We're just going to
so
start with that.
yeah.
So,
So Rivki, I'm gonna just answer your question. Listen, I'm going to be this is a shameless plug for my book. That being said, if anybody has ever looked at any financial books out there, or any books that anybody in the money space, there is a woman, her name is Barbara Stanley Houston. She was formerly Barbara Stanley. She wrote the book Overcoming Under Earning, Prince Charming Isn't Coming, Secrets of Six-Figure Women. She has 7 books that she's written. And I led her book club for her like community at the end of April. She said to me, "Debbie, I've read 40 books on money. Yours is the best beginner investment book I've read." So, and those are real words. So, like, really don't waste your time. I mean, that's not a waste of time. Like, God forbid, I have an entire shelf up there with like books and books, like Larry Swedroe, the only investment book you'll ever need. But my book is really kindergarten. So many of these books already expect you to start out with a certain level of understanding, but mine really goes basic, basic, basic. And then once you go basic, you've got the foundations and you can like jump ahead. So thank you so much, Kim, for sharing the link. So like it'll take you like 3 hours to read. I wrote it specifically in bigger font so that it would be less off-putting. Okay. Yeah. So get a hard copy because Kindle, I don't know, my Kindle is filled with a lot of things that I never touched.
For the sake of this interview, what do you love most about the book? Like, what is like 2 gems that are in the book that no one else is talking about?
Just the real basics. Like, it's so, so basic, and that's what I really love about it is that I really, like I slowed down the conversation for, like, all the things that I really missed when I was, like, supposedly this hot shot on Wall Street, and I missed it, and I wasn't investing my 401k. I got it, I thought I was earning money because it was in safe savings. It was in this kind of savings account, 5% interest. I was like, wow, that's a good deal. But you don't understand the cost over time of keeping something in a 5%, interest account that sounds good. So I'm going to give you a rule called the rule of 72. The rule of 72 says you take the number 72, you divide it by the expected return on your investment. Okay, so if your investments are in the stock market and you expect 10% return, 72 divided by 10 is 7.2, which means that you would expect your money to double itself in 7.2 years. Okay, so I put $100,000 in the stock market. I would expect it in 7.2 years. I'm going to have $200,000 if I just put the money in and walked away and went to the beach.
Everybody got that? This
You got to do the beach part. If you don't do the beach part, it doesn't work. No, but then you're like, oh, I found this high yield savings account. Like today you could go and you can do a search online, high yield savings account, 4%. And you're like, oh my gosh, 4%. That sounds amazing. It's going to take you 18 years to double your money, which means you can have in 7.2 years, you can have 100,000 to 200,000 and another double your money. You get $400,000 and you're only up to 14.4 years. But at 4%, because you're like, oh, this high yield savings account, and you're like in 18 years from now, you haven't even gotten up to like, the money that you could have already had in the stock market. And if you really don't need your money for 20 years, like you really, really are holding yourself back. You're handicapping yourself. Like even now, like there's a thought that, listen, as I get closer to retirement, I should invest less in the stock market. I'm going to be 62, God willing, in a month. I have like 80% of my money in stocks because I'm like, I want my money when I'm 80. I want my money when I'm 90 and I want it to keep growing. I just like, that's really, I think that's way riskier. I had a client when I was working in financial planning. She came to me 10 years after her mother passed away with her money in cash, and
10,
she missed is in cash.
10,
It was in cash.
10 in cash.
10 years because she was so afraid of
Right.
making a mistake. She was so like, it was like she had this like block around money. And I don't remember the dates anymore, but there was a huge financial crisis in 2008 and the markets went down. But in March 2009, it hit rock bottom and then boom, it's been basically going up since then. Yes, there's been fluctuations, but she missed that entire increase in the markets.
What do you think she lost in 10 years if she would have had that invested?
Well, if you put it, if I put it into the rule of 72, she could have doubled her money. So maybe we wouldn't have put it all in stocks, but we would have looked at her age and her family and other income that they're having. Because it's not just like what you're putting it in, but we have to look at the other sources of money that you have. We have to look about risk. We have to look at about your health situation. Like there's so many different factors that go into, creating your financial portfolio. Are you getting Social Security? Do you have a retirement fund? Like what other financial assets you have? So I don't like, first of all, I have to be very, very clear is that I let my investment license retire. So I'm not a registered financial advisor anymore. So all of this is my personal opinion. Okay. That we have to make sure that that's clear. I do have a very long history of working on Wall Street. I was a registered investment advisor for a while, but I'm not now. So this is all my personal opinion. Nobody should sue me, please. Um, I'm telling you what I do. But there are a lot of financial bloggers out there that are doing the same thing, by the way. So,
I want to
yeah,
move.
let's move
from
on.
this.
Let's just go back because there's like this is such a deep conversation.
It is.
Such a deep conversation.
So while we're in this part, so what I'm hearing you say this, and this podcast is called More Than Mindset. And this is exactly what we're discussing right now, which is they have to have the mindset. Like you're saying with the lady, her mindset was broken and blocked. So,
Yeah.
how important is the mindset? I know you have this wired for wealth, and really it is about the frequency and the understanding and the changing. So, changing of the mind. So,
Yeah.
in your experience, what was the mindset shift?
Listen, the mindset shift is like, I can do it. Like, really, that I can
Mm.
figure it out. Like, and I think that there's a slide here. Like, it's really not rocket science. I know that, and I even have a slide here. Like my underlying belief is that the financial industry does not want you to understand money. You get your financial reports. There's so many numbers that you got like a block. You would like put it into the pile to deal with it later because you're like, oh my gosh, all those numbers, and there's this terminology, and you don't understand it. And once you have like a few basic terms under your belt, it's really simple. But the financial industry doesn't want you to know that because they get to charge really high fees if you don't know it. And there are fees that are coming and going, and they charge you on the way in, they charge you on the way out. And if you don't know what you're looking at, and they're like, yeah, we give you 5% interest. Isn't that amazing? And you're like, sure. And nobody's told you, but yeah, you're like, you have like another 20 years before you retire. And if you put the money in stocks, which look risky, but they're really not over the long term, then your money is going to be worth twice as much. I have like 6 big reasons that people don't invest, like start investing, and why it's difficult and why they don't stay the course. Okay, so overwhelm, the jargon, and you've got so many choices. You're like, I'll figure it out later. Like that's the paradox of choice and decision fatigue. You're like, I don't know. Let me just think about it tomorrow, right? You believe that you need to make more money first. You don't have enough to get started. Your income's fluctuating. You might have a big expense coming up. You don't know who to trust, right? It's intimidating. It's a man's world. You don't want to make mistakes. We've talked about this. And maybe there's taxation issues. And that's especially for some of my people, like in Israel, we have taxes in Israel, taxes in America. Or if you're American and you're living in a different country and you have like different tax legislation, like it can be very confusing. You're like, I don't want to pay taxes. Let me just keep it small. Let me just hide it. All right. We have to like make tracks here. As I said, I think the financial industry like really wants to keep the wool over your eyes, but we don't need to do that. We can really take charge and create our own financial confidence. So here you go. Mindset reframe. As if you ordered it. Investing isn't rocket science. Like it really, really isn't. I really do believe it's simple. And if you figured out how to like click a link on Zoom to get here today, like you have enough intelligence that you could figure it out really. It's just it's committing to learning something new for 5 to 10 minutes a day. And that's it. It's just the commitment. So, you can ask yourself, do you want to have financial anxiety? Do you want to be overwhelmed? The American Psychological Association says like 75% of the American population has financial anxiety. Or would you rather learn about investing in bite-sized chunks and slowly but surely develop your financial confidence? All right. For those people who say I don't have enough to get started, right? Investing is how you make your money work for you. It compounds and grows in the background so you can also take care of your future self. We're sometimes so focused on our present self that we don't think about it, but like that day is going to come. And I love the quote that it's attributed to Ayn Rand, which is you can ignore reality, but you cannot ignore the consequences of ignoring reality. Like the reality is, folks, that we're going to get to 80 and we're going to get to 90, most of us. And if we don't think about our future self, then he is going to be a little bit like short for cash. Small amounts add up over time and like commit to starting. Even like, Kim asked for a formula, $1 a day. And you talked about your Christmas fund. I had my Passover fund. I had a shoebox. I used to put every week, like I took 100 shekel note and I put it into my Passover box because for us, that when we're celebrating Passover, it's a big expense. Or I put it for summer camp, but I like had a little shoebox with cash in it, and that's how I took care of it. And whether you use an envelope system or you have a bank account, like just another line entry at your bank where you're slowly but surely moving money over. I had a client, I talk about her in my book. She committed to $2 a day and she got to $5 a day. And I think by the time we stopped working together, she was committing, because she was an entrepreneur and her business was making at least a $500,000 when we stopped working, with each other, 500,000 a year. She was putting away $20 a day. Like, just think about that. That's $600 a month. That's like a lot of money, right? Like that will really give you a lot of, oomph to your investing, right? So don't abandon your future self. You've got to establish financial habits now while you're busy taking care of your present self. And it's a little bit of a time warp thing because you want to eat today, but you got to remember that you're going to want to eat tomorrow also. All right, big upcoming expenses. Okay, so this is not what your investing is for, unless you're like, putting money away when your kids are like 2 and 4 and you're saving for their college funds and wedding funds and things like that. But if you know that you need to replace your car like next year because your car is like 10 years old and it's like on the fritz, right? That's not what investing is for. That is what you need to use your cash management, your budgeting for. What we already talked about, those are regular expenses. Like if you buy a car, you know that at some point in the future, you're going to need to replace that car. You buy a computer, you know that at some point in the future, you're going to need to replace the computer. But we're always trying to like juggle it around and try and like, borrow from this account and that account, to make things work. But that's why putting money away for those fluctuating expenses or irregular expenses makes so much sense. All right. As I said, don't tap into your income for short-term stuff. You need your budgeting system, your money management system, and also in your business. Like your business is going to need future investing also. Like, you need your like annual Zoom account, but if you want to invest in a coach, if you want to do a website, websites are like $10,000 plus minus, right? So that's something that you want to put money aside for so you don't have to put it on a credit card, but you know that you're saving for it. All right, so let's just talk about your fear of losing money, making dumb mistakes, and like really with anything, we learn by making mistakes and we self-correct. Like any child, if you've got kids, watch them on a bicycle, watch them walking, right? They get up, they fall down, they skin their knees. But for some reason with money, we make such a huge deal about it. As I said, no money, no food, I'm going to die. So you've got to like take action before you're ready. You learn by doing. My mistake, I don't suggest you make a big mistake that I did. I invested $75,000 and lost 50 of it. So that was a big ouch. Start small. I learned the hard way, the University of Hard Knocks. So don't do what I did. And don't do anything silly like I did with your money. If you can't afford to lose it, like thank God we were okay. As I said, I had a big chunk of change that we put away into an investment. And, that was a painful mistake. And it took me a while to tell my husband, by the way, because I felt so bad about it. But don't do anything silly. And this happens. People like they get excited. Somebody comes and sells you something, in the Jewish world, the chasna money, the wedding money, and people put their money and promise 13, 14, 15%, and then poof, it like disappears. If you don't understand it, if it's so complicated, if somebody's just like so eager about it, like that is a huge, huge, huge red flag that maybe there's a lot of information that you don't understand. All right. And this is, I love this quote by Brene Brown. She's a shame expert that shame cannot survive being spoken. It cannot survive empathy. And that's why I talk about my mistake, right? Like there was a time that like every time I talked about it, I felt this heat rising up in my chest. And now I just talk about it as it's like, okay, that's what happened. I made a mistake. And I learned from it and I moved on. So if you made a mistake with your money, we learn from it. We're grown-ups and you move on. So instead of focusing on building a winning investment portfolio from the get-go, because we're like so afraid of losing, right? We're like, oh my gosh, I don't want to lose anything. And I have to have the best, best, best thing straight away. You really want to focus on your process, which is the consistent steps you're taking to become confident, to become successful. So that's like the $100 a month. Like you just put it aside. You learn what an ETF is. You go and you put some money into an ETF. You do it again the next month. You've opened up your account with like Vanguard or Schwab or Fidelity, and you do it again. I have a client and her mother passed away a couple of years ago, and we started working together financial planning, and she was really totally blocked. And we built her investment portfolio, and listen, she's never gonna be a fish in water around her money and her investing, but the way she talks about money now and how much more confident she's become, it took her a year plus, but she's a different person, and her portfolio is a different portfolio because she did it step by step by step. All right, here's the missing link, really, and where we are getting close to the end is the money is not just something that you do. We earn, we save, we spend, we invest, and it's not just something you have like $1 million portfolio or an investment property. Money is how you live your life on purpose and in alignment with your values. Right? Money is a tool. Money doesn't make you more of a person who you are. I mean, I think money amplifies who you are. If you're giving money a person and you're giving to charity and you're sharing and your resources and, things like that. We also know that people gamble with money and people squeeze people and whatever, like they do mean things with money. But, money is how you can use your money for a purposeful and meaningful life. So some of the values, this is like here, the values are really in the middle. So you've got your mindset, your future self. We have to remember your future self having systems and strategies like we talked about, your system for monthly, watching what your personal expenses are, your business expenses, putting money aside, making sure you're taking care of your present self today and your future self tomorrow. So this is like, but your values are really, that's the thing that is you want to start from your values. And we're just going to look at a quick, bullet points of some values. Like you want your money for safety and security. You want your money maybe to take care of your family. You want your money to, do chesed, we say in Hebrew, charity, making a difference in the world. You want money to travel and have fun. And maybe that is connected with your family, right? You want your money for your health, take care of yourself, well-being, peace of mind, self-care. You need a massage, you need a vacation. But what are your values? What's important to you? And when I was working in financial planning, so many people came to me and they said, I don't want to be a burden on my children. And if that is a value for you, because that's part of your family, then figure out your money now so that your future self doesn't have to become a burden to your children. All right. Success doesn't come from what you do occasionally. Success comes from what you do consistently. All right. Thank you so much for tuning into this episode. I really hope that you found something, one thing, two things that you can take away from this webinar. And again, I'm going to put into the show notes the link to the full webinar. So if you want to go watch it with my gorgeous slides, you can do that as well. And I do want to remind you that if you go to my website, debbiesasson.com/book, you can get a copy of my book, The 1K Investor, Simple, Smart Steps to Start Investing with $1,000 or Less. My underlying belief that money is not rocket science. Investing is not rocket science. There's some terminology that you might not know, but I do believe that you can overcome that quickly. And if after you read my book or even before you want to schedule a one-on-one session, you can also go to my online booking calendar, debbiesasson.com/consult. Schedule an initial consult with me, and I will help you really understand. And it can be, as little as 1 hour. It could be that you have some other money limiting beliefs, any money trauma or money healing you have to do. It might result in us working together for a longer term package, but there's so much that we can accomplish even in a discovery session. So you have the webinar, you've got my book, and you have a link to schedule a session with me. And I look forward to seeing you next week on the Jewish Entrepreneur Podcast. Bye-bye for now. Thanks for listening to the Jewish Entrepreneur Podcast. If you want to stop underselling and under-earning and close more sales, you need to clear the limiting money beliefs that are sabotaging your business growth. Head on over to debbiesasson.com/mindset and download my free Money Mindset Workbook. Uncover and dissolve money blocks like hundreds of other entrepreneurs who are now building 6, multi-6, and 7-figure businesses and creating true financial freedom.